Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Netflix Inc. annual report. Netflix offers a wide range of entertainment services worldwide. The company provides various types of content, including television series, documentaries, feature films, and live programming across multiple genres and languages. This diverse selection caters to different tastes and preferences. In addition to its vast library of content, Netflix also offers streaming capabilities through various devices. Members can access their favorite shows and movies on TVS, digital video players, TV set-top boxes, and mobile devices, making it a convenient option for entertainment on the go. The decline of Netflix Inc.'s stock price over the past year can be attributed to several key events and factors. One major contributor was the announced plan to acquire Warner Bros. Discovery for $82 billion, which raised concerns among investors about the potential success of such a large merger. The mixed track record of past media company acquisitions and Warner Bros.' own history with unsuccessful mergers also contributed to skepticism. Another significant factor was the slowing subscriber growth, which marked a considerable slowdown compared to previous years. This deceleration fueled investor worries about market saturation and intensified competition within the streaming industry from rivals such as YouTube, Amazon Prime Video, Disney+, and Apple TV+. The valuation concerns and market sentiment towards the streaming sector also played a role in Netflix's stock decline. In addition, lower-than-expected profit forecasts and disappointing subscriber growth figures further contributed to the decline. The company's decision to pause its share buyback program to conserve cash for the acquisition also created uncertainty among investors. Furthermore, the reported 90% drop on November 17, 2025, was attributed to a combination of factors including disappointing subscriber growth, a weaker-than-expected outlook, and heightened competition in the streaming market. The Q4 2025 earnings reaction also saw further declines in Netflix's stock price, despite meeting or exceeding sales targets and reaching record subscriber numbers. Investor sentiment was negatively impacted by management's warning that increased content spending and integration costs associated with the pending Warner Bros. Acquisition could put pressure on future margins. The continued pause in the share buyback program also contributed to investor unease. Overall, the decline of Netflix Inc.'s stock price over the past year can be attributed to a combination of factors, including concerns about the Warner Bros. Discovery acquisition, slowing subscriber growth, valuation concerns, and lower-than-expected profit forecasts. Netflix Inc. market capitalization of $363 billion is significantly larger than the average industry peer of roughly $16 billion. This shows that Netflix Inc. holds a significant advantage in their industry. Netflix Inc. trades at a higher price-to-earnings ratio of 34 times and a higher price-to-book ratio of 13.59 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. The leverage on the balance sheet appears elevated, with liabilities of 54% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Average liabilities have increased consistently as the company expands. Importantly, both assets and shareholder equity have grown at least 20% faster than liabilities, indicating that the business is expanding substantially and generating value after covering its obligations. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The company has consistently reduced its share count, while revenue and equity have grown, indicating disciplined buybacks that enhance long-term per-share value. The income statement shows that the company have been growing its revenue annually, and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth or decline can be identified through a review of the financial report's extracted summaries. On the growth side, key factors include membership acquisition and retention, streaming revenues, original and exclusive programming, global expansion within operating margin targets, growth in memberships, price increases, and increased advertising revenue. These drivers have contributed to significant revenue increases, with notable examples including a $6.2 million increase in streaming revenues and 50-minus 21% growth in memberships across various regions. On the other hand, revenue decline is primarily driven by discontinued DVD revenues, unfavorable changes in foreign exchange rates, and a decrease in content assets additions. Other factors that may impact revenue growth or decline include competition from entertainment providers, government regulations, litigation, fluctuations in membership plan mix and member engagement, and the ability to attract and retain advertisers. These drivers highlight the importance of adapting to changing market conditions and consumer preferences to maintain revenue growth. The net income of the company experienced a significant fluctuation between 2023 and 2025. In 2024, it decreased by $2,273 million, resulting in a 26% decline from the previous year's figure. However, in 2025, there was a notable increase of $1,269 million, representing a 24% rise over the 2024 net income. The profit margins also underwent changes during this period. The operating margin saw an improvement, increasing by 2.8 percentage points from 26.7% in 2024 to 29.5% in 2025. This increase suggests that the company's operational efficiency and cost management were effective in enhancing profitability. Several factors contributed to these changes in net income and profit margins. The rise in effective tax rates due to reduced federal research and development tax credits was a significant factor. Additionally, the growth in income before taxes outpaced the growth in excess tax benefits from stock-based compensation, further impacting net income. Foreign currency fluctuations also had a negative effect on profit margins. The combination of these factors resulted in the observed changes in net income and profit margins between 2023 and 2025. The company's ability to adapt to these challenges will be crucial in maintaining its financial performance moving forward. The company's debt level and interest expenses have undergone significant changes over the past year. In terms of debt level, there has been a notable decrease in short-term and long-term debt by $1.12 billion, minus 7%, from 2024 to 2025. Additionally, debt repayments increased by $2.63 billion, indicating that the company is actively paying off its debts. However, the total debt level as of December 31, 2025 is $64 billion, which is a significant increase compared to the unspecified amount in 2024. This discrepancy suggests that while the company may be reducing its short-term and long-term debt, it still has a substantial amount outstanding. Regarding interest expenses, there has been an increase of 8% from 2024 to 2025, with a total of $776,510 in 2025. This is a notable rise compared to the previous year, indicating that the company's debt burden is increasing its financial obligations. Management is optimistic about the company's outlook, citing opportunities for global expansion while maintaining an operating margin target. They believe that original and exclusive programming can help differentiate the service and attract members. To achieve this, management aims to secure exclusive rights for content, including original content, and maintain a compelling mix of content. The company expects revenue growth from memberships, price increases, and increased advertising revenue. Management is also investing in technology and development, driven by personnel-related costs and higher share-based compensation expense. They anticipate sufficient cash flows from operations to meet needs for the next 12 months and beyond. However, management acknowledges growing regulatory action and potential restrictions on content, which poses a risk to the company's growth. They are also concerned about potential disruptions or interference with Amazon Web Services, Oz, and network operators' handling of data access and charging practices. In terms of strategy, management is focused on preserving capital, liquidity, and return, with a policy to hold securities for the long term rather than short-term gains. They expect to incur substantial debt in connection with the WBD transaction and may seek additional capital through equity or debt securities. The company anticipates periodic refinancing or restructuring of debt. Overall, management strategy is centered around growth, differentiation, and risk management. They are committed to investing in technology, content, and talent while navigating regulatory challenges and maintaining a strong financial position. The company has been actively involved in share buybacks over the past few years. As of September 2023, it had authorized a significant amount of $25 billion to purchase shares. This authorization was an increase from the initial $10 billion set aside for this purpose. In the fiscal year ended December 31, 2025, the company repurchased a substantial number of shares, totaling 86,536,215, at a cost of $9.1 billion. This indicates that the company is committed to reducing its outstanding share count through strategic buybacks. With a remaining available balance of $8 billion for repurchases, it appears that the company has ample resources to continue this strategy in the future. That concludes the financial summary for Netflix, Inc. Feel free to comment below, and I will be happy to answer them when possible.